and welcome to this interview series where we bring you the minds behind managing your money. Every week, we delve into the philosophies, strategies, and the ever evolving dynamics of the financial markets through the eyes of seasoned professionals. And today, joining me and my colleague Chirag is Cheenu Gupta, Fund Manager Equity at HSBC Mutual Fund. Welcome, Cheenu.
Yeah, hi.
Could you start by telling us what drew you to equity investing after completing your BE in information technology?
Yeah, sure, Ruchira. So I have to begin with by saying that it was not my particular interest per se when it came to the background. So I come from a family which actually only invested in FDs. So all that I saw while growing up was just investing in FDs, and if there is more anything added to it, maybe some bit of ULIPs, and that too coming from some other financial influences that you might say. After my BTech, I had joined the IT industry and I started working as a software engineer, you may say. Coding was really my passion. And what drew me to coding again was the analytical part of it, how you design the code, how it worked. That was the thrill part of it. But what I saw there in the career journey was that after a couple of years, people want you to shift as a manager of the team and not a coder. So your analytical work that you do really goes down and your people management work just takes over. So I realized that, okay, this is not something that exactly I wanted to do. And then I realized that it was time to do something different. And maybe MBA would be something which would give me that added skill set. When I did my MBA, that is where I got introduced to this world of stocks and investments. So during my MBA itself, I think we as a group of college friends, we got interested in equities and the stock markets. And in fact, what I did was took my second year fee as a loan from the bank, and whatever fee my mom had put aside for my MBA, I started investing in the market. So that was my first exposure, learning hands-on investing in the market, more like the nuances.
So, Chinu, I've heard, there's a great story about you or starting with the mutual fund industry. Could you share that with our viewers? It involves an inter-college competition and a significant figure in the industry, right? So what was it?
So yes, Chirag, actually, it is indeed a story, I must say, and it is something which got me to believe in luck, which over time, being in investment, only got intensified. Believing in luck. So how I entered the industry was something very different. I had finished my second year MBA. Placements were done. So I had secured my placement with one of the top private banks in the country and got my preferred role. So very happy. And we were done with our graduation ceremony, everything. And we were about to pack our bags and go home. So almost when everything was done and we were heading home, there was this news of a contest being set out by a mutual fund. And instead of liking the contest, I must say it was the prize money that drove us, because it was a 1 lakh money. And as students, that sounded like a really big sum. And I and my friend decided that no big deal, maybe we could wait back for 2 days. So everybody else had packed their bags and gone home. It was an empty hostel, I still remember. We waited back 2 days, prepared for that contest, participated in that event, and actually ended up winning it. And so we were all excited about that 1 lakh money which we were winning. And when Mr. UK Sinha, he was there, so the UTI chairman, he was there on stage, he gave us the money. And for us, that was enough. But I think the audience asked him that, okay, what more? 1 lakh money. And what more are you giving these students? And then I think he graciously announced that, okay, they are also getting job offers in a company. So I think that is how we ended up getting job offers. So we were awestruck that time, still waiting. Going back, I discussed with my professor that, okay, my placement is done, but here we are getting this opportunity. And then I think my professor really advised me that it's a good field to enter into and a beginning. And that is how I landed in the industry.
Well, that's quite an interesting story. Now, looking back at your early days as a research analyst at UTI and later experiences at Tata, IIA, Life Insurance, and Canara, Robeco Mutual Fund, what are some of the key lessons that you still carry with you today?
So I think I began my role as an analyst. So as an analyst, what you do is you cover a couple of sectors and you look at all the companies in that sector. So what I realized vividly was that given the same industry dynamics, demand supply situation was almost similar for all the companies in that domain. Even the vagaries of the market were similar. All of them faced the same pressure in and out. However, the performance was very different. So that brought a very important lesson to me that execution is something which is very, very critical and is something not easy. So it's very easy to get strategies on paper, get someone advising you and drawing all the strategies. But when it actually comes to putting it to work, the on-ground execution, that can be far different. So it was that time that I really got this underlined for me that, okay, if some company can execute the way that they are planning to do things, and in difficult environments. Why difficult? Because being in India, almost all markets are very competitive. If you can actually manage to do that, then I think that's a critical asset. So that was one part. Another lesson that I learned is usually when you enter the industry and you talk about picking stock, it starts with valuation. Almost after the first question, what the company does, if an outsider is picking a stock, the second question will be, what's the valuation? Right? And that is how people pick up stocks. Again, as an analyst, I learned an important lesson that it's far more important to err on the side of valuation than miss a good company. So many times you feel that valuation is very important. We look at the P ratios and compare companies, but I think that is just one of the parameters. There are several other things which go into making a great company or picking a great stock. So that was the second most important lesson I must say.
Cheenu, another thing was, earlier with the L&T and now with the HSBC, which is a global company. So in a merged entity with an overlay of HSBC process, how has your life changed? What do you do differently now, which you're doing earlier?
So Chirag, actually the process of picking stocks, selecting the companies for investment, pretty much remains the same. But I think it's a good question that HSBC being an MNC and with the heritage of having global asset management practices with them, they've got certain practices. So something like after every month, if there is a good outperformance or a bad underperformance, they make you reflect. And it's like a reflection question sent to you that what do you think caused that outperformance or underperformance? So it's a short paragraph that you have to write if there is, as I said, outperformance, underperformance. So it just helps you reflect, okay, what got those and whether those factors will stay or those could change, whether you should change your strategy. So it makes you more reflective. Apart from that, the resources available are far better. One, with L&T and HSBC coming together, the resources got merged. So earlier, L&T had 5 analysts and HSBC had 3. Today, we have a team of 8 analysts. So that merging happened. At the same time, we have the global analyst available to us if there is any query. So if there is something going on in China, if a company in India is doing something in China and we want to really figure out how it's happening, we can speak to the analyst, HSBC analyst at China and figure out how it's happening. So be it Europe, be it China, be it other geographies, I think those information are far more accessible to us.
Moving on, how would you describe your personal investing style? Are there any types of stocks or market situations that you find particularly appealing?
So my investment style generally has been a bit more growth biased. And as I said, being in a growth economy like India, you understand that the value of growth is far higher. Apart from that, what really interests me is understanding how a company or an industry is suddenly changing its trajectory. So it might be on the back of some situation. Many times it happens that the dynamics that the industry is facing, it could be the regulatory dynamics, it could be the competitive scenario within the industry that is changing, or it could also be the underlying demand. Just to give an example, India being a country 15 years back had a demand for a certain category of goods. Today, you notice that change with premiumization, etc., and the demand has moved in a different category. So when these dynamics change, a different set of companies do better altogether. So noticing these changing patterns within an industry or with a company, I think that really gets me excited. If I'm able to spot it and understand it, that is interesting. Apart from that, if you see that if there are particular sectors or industry where the return ratios have not been good, so generally in investment, most of us follow the principle of investing in companies which make healthy return ratios, good cash flows. But sometimes there are these pockets of sectors or industries where you see that these return ratios have been bad, but for some reason, these return ratios are improving. And just to give an example, it would be something like a hospitality industry, where earlier it used to be very asset heavy and have low return ratio. But over the time, maybe they changed their pattern. They got into the mix of asset heavy and getting more managed rooms. So which changed the business model of that industry as such. So spotting these industries where the underlying return ratios themselves could be changing. I think, again, that is something very interesting. So these are the particular instances which really get me excited. And maybe on the other side as well, if you are able to spot before time when it's going down, something had been doing really good, but you understand that there is a change, a shift that is happening. Again, an example would be the viewer habits. Earlier, people wanted to go out and watch movies. Maybe it's a bit lesser now. So, but noticing these trends beforehand and getting those in your investment, I think this is something that I really like.
Cheenu, what makes a stock a compelling buy or must buy? What is the criteria which makes a stock compelling buy for you?
So Chirag, it would be in continuation with what I said, what I learned as an analyst. So many times we all have our thesis that, okay, a particular company has to perform in line with the broad industry dynamics. This is the kind of growth that that company will show. This is what should happen. But there are some companies who kind of tend to do better. And they do it better, not like a one-off situation, say 1 quarter, 2 quarter. But there is something different in the underlying which can show those better returns with more consistency. So those kind of companies which end up doing that, and we've found that there are several reasons to it. Either they get the distribution excellence in place, or they have agile managements who can respond to different situations better time to time. Or it could be just the products that those company has. Those products have got better demand. So because of these reasons, these companies end up doing not just what the industry is expecting them to do, but better than that. I think these attributes in a company really make it a compelling buy for me.
All right. Now, Cheenu, we noticed that the HSBC mid-cap and small-cap funds have significant investments in industrial sectors. So what's the strategic reasoning behind this concentration, if you could explain us?
Yes. So industrials is one sector that has gone through a deep under cycle, you must say, a low cycle. Last 7-8 years, you've hardly seen investment coming in from the industry. Even the government capexes earlier were not to an extent that we are seeing today. So this was a sector which was actually turning around, which was seeing that change happening. Even today, as we are talking, where capex has come up, it's mostly come up on back of the central government expenditure, or to some extent supported by the state government. If you look at the real industries, they are still not come back with all their capex. So what we are saying is, in addition to the expenditure in capital that government would be doing, be it in infrastructure, railways, power, a lot of investment this country needs. Apart from that, now the industries have to come and pick up on their capex cycle, which has been running low for a few years now. So addition of these two capex could really take the country in a different capex regime, and the companies which support it are the industries. Apart from that, there is one more factor that we are trying to bring back manufacturing within the country. So we have been a country which consumes, and we were consuming various items, but which are getting imported. Slowly and gradually, with government focusing on shifting that manufacturing chain into India, you get various companies again who want to do manufacturing. And these industrials are the company which support establishing this manufacturing chain within the country. I think these various backdrop make this sector really interesting. And that is one reason you will find that industrials has been an overweight for us for quite some time now.
Cheenu, you manage around 10, 11 scheme across the equity and the hybrid at the HSBC. So what different perspective do you bring, or, how do you split the responsibility between the co-managers? Because you co-manage it with the other fund managers. So how do you divide the work or split the work and responsibilities while managing these funds?
So, right, Chirag, even when you mentioned 10, 11, it sounds huge to me. But it's that division of fund manager and co-fund manager. So, as I said here, the role of a co-fund manager is more like a backup fund manager. So, if there's any emergency and the fund manager is not here on leave and some certain trades have to be executed, then the co-fund manager comes into the play. So, actively, I'm managing 6 schemes, to be precise, and in other schemes, I'm the co-fund manager. So, in those 6 schemes, there are schemes which have different mandates. So just to give an example, I'm managing large and mid category. So there the mandate is that large caps have to be 35% minimum, mid cap have to be 35% minimum, and the remaining can be any other category. So when I'm picking stocks, I think this mandate of the scheme helps me identify that how I have to design this scheme. At the same time, within the scheme, we follow a certain idea. Like a large and mid fund that I'm managing, I have kept it like a top down plus bottom up approach. You look at the sector weightages, and you get the best picks in the portfolio. Maybe there would be some other schemes, say the multi-asset category, which we just launched, which we are building up more like a bottom up portfolio. We are not so much focusing on what is there in the benchmark, how the sectors are there, but going with the best picks what we can find available to us, because there the market cap ranges have not been fixed. So different schemes, because of their mandates, help us to follow these different approaches. The line of thinking remains the same. So you will end up noticing that when it comes to the sectors, the overweights, etc., will be similar because of the style of thinking of the fund manager. But when it comes to picks within the scheme, there would be variations because of these different mandates.
But what unique insights or approach do you believe you bring to managing these funds?
So sure, Ruchira, to add to that, I would say that the way I look at stocks usually is like bucketing it into three different categories.
Okay.
Some particular type of stocks are there in my portfolio for stability. Usually these would be the leaders in a sector that you have, the large cap stocks. So somebody like a HDFC Bank or a TCS, now even an SBI, you wouldn't question on how they are doing things. So they get stability to your portfolio. Then there is the next category of stock, which is like saying the growth drivers in a portfolio. So these are the companies in the sectors who are growing tad better than the sector itself. And I think we spoke about various reasons. Either their execution is better or they have better products, because of which they come in the second category. And then there is a third bucket of stocks in the portfolio, which I talk about more like the turnaround stocks or the thematic stocks. So at times there are some themes running, something like online purchase or retailization of consumption or EVs that are coming up. So these themes are there, or there are turnaround sectors, again, that we spoke about, sectors which were earlier not into focus, something like a power, which was just not there for last 7-8 years, but now becoming very important. Hospitality at one point of time was in that domain. Mid-cap IT companies could come in that domain. So this is the third bucket of stock, which is really very interesting. So all the new ideas that get germinated are usually in this third category. So in a portfolio, around 20-25% weightage I give to stable stocks. So they are there for more for support of the portfolio, more for liquidity of the portfolio. Weightage in them would be an underweight. You know that they are stable, but they may be growing a bit slower than the industry. The second category is the heart of the portfolio, which give you compounding returns. So they are good executors, but they are known to all. So that is around 40-50% of the portfolio. And as I said, the third category, which is around 30-35% of the portfolio, is this category where we are looking out for trends or turnarounds or anything which catches our eye. The confidence may not be very high, but we would want to experiment to get that new idea into the portfolio. And I think over time, what I've seen is a stock enters into that category, and there could be two outcomes. One, it does not deliver on its promise. We thought that, okay, the change in management would do certain things, but it doesn't fructify. Then you put it out of the portfolio. The weightage that you've taken here is not very high in this third bucket. On the other hand, if that management is able to deliver on what they're promising, or the industry tailwinds are really changing, then that stock becomes very important and enters the growth category. So we've seen several stocks in our portfolio who first entered in this third category, but over time with good execution and delivery, they came into the second growth category. So this third category really acts like the window for the portfolios where we pick the stocks. So overall, the portfolio composition, this is how I think about the stocks when I'm looking at them, and this is how I form my portfolio.
Coming to the fund specific thing, if you look at the HSBC Midcap Fund, it has done quite well in the last 12 months or so. The 1 year returns have been positive compared to the 3 years and 5 years. But there seems to be a lot of volatility compared to the peers. So how do you plan to bring the stability in the returns of these funds?
So yes, Chirag, very good question, and I think this is something that me and my boss are also putting our heads to. So I must also tell you that this is one fund that I have recently started managing. I was not earlier managing this fund, and there has been a change. I've now started managing this fund some time back, and the idea here and the thought process here is again to look at this fund in the way buckets that we have described. We should not have erratic stocks, and we should not have all the stocks in the portfolio which are just like bets. As I said, some stocks there for stability, where you do not question. Maybe the returns may not be great, but they give that stability. Again, in that growth portfolio which we spoke about, these are compounding stocks. So when you're saying that, okay, returns have to be consistent, so this is that engine which has to give consistent return to the investor. So you don't have to worry. The last bucket is where we want to hit those sixes and fours which we can. So it's like saying in that cricket, what we say one day cricket, that you have to go for ones and twos, which are very important, which would be the first two buckets of a portfolio, and then we would try to act in this third bucket. So I think with this composition, volatility should go down. Again, the kind of stocks that we want to get into would be the ones where we have some confidence in how the management is going to execute, some greater understanding of how that industry dynamics will be moving. So whenever we are evaluating a company or an industry, there are several things you look at. There are factors, just to give an example, maybe something like in a chemical sector, there are spreads that you talk about. Now, these spreads depend on several things. Demand supply, which is there globally, they can vary suddenly. So you do understand that there are sectors which are dependent on things which are not very much under the control of these managements. So what output you're giving is not very well controlled. The probability of returns could vary. So more and more, if we can find companies where probability of this delivery can be better, or to say that things under control of the management can be higher, I think those are the kind of companies that we would want to get into the portfolio.
All right, now, Cheenu, given the recent strong performance of mid and small cap stocks, do you think this momentum is sustainable?
So yes, Ruchira, interesting question. We ourselves have seen such a strong rally in mid and small cap stocks, and what has changed over time is definitely the comfort and the valuation. If a year and a half back, we used to find a good idea in this category, especially small cap, at say 14, 15 times. Today, we are looking at around 20, 22 times easily, even in the small cap category. Mid caps have almost always been expensive, and they continue to be that. I believe they are the category of stocks which are most identified, and they are the growth drivers, because they are after leaving the top 100, they are the next 150 companies in the country. So they ought to be doing better. So mid cap is that category. Apart from that, in small cap, what we have done is tighten the filters. So we are still finding a lot of good ideas, especially in categories like discretionary consumption. We all know that India is going through a path where the per capita consumption is just rising. Even the GDP per capita that we talk about is at a range where there could be that J curve that we've always been talking about. So all these factors make discretionary consumption really interesting as a category. And there are several sub-pockets which are there in this area. So we find a lot of mid and small cap companies in that area. Again, the second category that I spoke about, manufacturing. So in manufacturing, when this entire supply chain is being set up, so today as a country, we are talking of manufacturing going up as a proportion of GDP to even close to 20% from the levels of 16, 17% where we are. So as that happens and supply chains start developing, you will find several mid and small cap companies which will emerge to fill in that supply chain. So again, I think that a lot of companies will emerge in this space of manufacturing, again in the mid and small cap category. So no dearth of ideas there. Added to that, the corporate governance level, I must appreciate, has really gone up for these small cap companies over time. The kind of small cap companies we saw in investment 10 years back, they are far better now. The understanding of leverage that these companies have, the small cap companies, is far better today. So earlier, we used to find small cap companies with very high leverage. Today, if we see that the use of leverage for companies has really gone down, and promoters do understand that instead of using leverage, it's better to raise money from the equity market and build up. So with all this understanding, I think mid and small cap companies have become a good area. You can find a lot of picks, but just with the valuation, I think the filters have to be really tight. all may not cross the filter, and execution will really become important for them to deliver on the promises.
So, Cheenu, as you mentioned, it will be a little bit difficult to find the value in the mid and small cap segment. So, apart from the consumer discretionary and manufacturing sector, which are the other themes where you're looking at the value at this point of time?
Chirag, value, I think, is really difficult to find out. When I look at the P ratios, it's really difficult. Maybe that's why we are looking at another parameter like PEG ratio, where you put the P ratio with the growth. So many a time there are instances that putting these ratios together, you find set domains. So again, when you put aside manufacturing and discretionary consumption, I would not do that, because I would just add industrials and infrastructure to that. Those would be other two sectors. But again, these are large sectors. So no dearth. When I say industrials, it's not one area. You have auto ancillary companies making bearings, which can be industrial. You have component supplier to railways, which can be industrial. You have companies supplying in the power sector, which can be industrial. So these are large sectors. So when you go to find ideas, I think there could be a number. Similarly, as I said, in discretionary consumption, it could be the apparel category you would want to look at. It could be the online delivery category you would want to look at. So again, various subsectors emerging there. And apart from that, as I said, the government's focus on infrastructure. So that could be another interesting sector to look at, because you are looking at development of several airports, ports, and other infrastructure within the country. So I would add industrials and infrastructure to that list.
All right. With that, I think it's time for us to wrap up our chat for today. I'm sure our viewers will benefit from the insights that you've shared. Cheenu, thank you for answering these questions. It's been great having you. Thanks.
Yeah, thanks, Chirag. Thanks, Ruchira.
Thank you. Thank you.